All right, folks, let's dive into the fascinating world of geopolitics and how it intersects with economics, finance, and investment. This topic is essential for CFA Level 1 candidates as it can significantly impact investment decisions and strategies. We'll go through this step by step, just like a coach would in a classroom setting. So, grab your notebooks and let's get started. First off, geopolitics. This is all about how geography affects politics and international relations. Imagine analysts as detectives, trying to understand how various actors like governments, organizations, and individuals interact and what drives investment performance. These interactions influence economic growth, market volatility, and transaction costs. Geopolitical risk arises from tensions or actions that disrupt international relations. Think about it like this. If countries or major actors have a fallout, it can shake up financial markets and affect how assets are allocated. This risk can impact macroeconomic growth, interest rates, and market volatility, and it also affects the suitability of investment portfolios. When we talk about actors, we're referring to the various players involved in political, economic, and financial activities. These can be state actors like governments, political leaders, and groups that control national security and resources. Non-state actors include NGOs, multinational companies, charities, and influential individuals like business leaders and celebrities. Countries can either cooperate or compete. Cooperation might involve standardizing rules, harmonizing tariffs, or sharing technology, while non-cooperation can mean inconsistent rules and closed borders. There are all kinds of reasons nations buddy up, whether it's for military, economic, or cultural reasons. Let's break it down, and I promise to keep it lively. First up, national security. Countries team up to keep their people and resources safe from all sorts of threats. Think military attacks, terrorism, cyber attacks, you name it. Geography plays a big role here. Nations lacking direct access to the sea are landlocked countries. These guys need their neighbors to get resources, so making friends is a must for survival. Conversely, countries with strong ties to trade routes are called trade route countries. If a country's smack dab in the middle of major trade routes, it can use that to flex its muscles a bit on the global stage. Next, let's talk money. These days, national security isn't just about armies, it's also about economic stability. Collaboration helps countries secure resources, promote trade, and keep things financially steady. Now, onto resources, rules, and influence. Geophysical resource endowment. Resources like food and water are scattered unevenly around the world. This leads to some interesting power dynamics. If a country's got the goods, it can throw its weight around a bit. Standardization. Think of it like everyone agreeing on the same rules for a game. It makes trade and economic growth a lot easier. Sometimes countries cooperate because of shared culture, history, or similar experiences. Soft power. This is all about influencing others without using force. Things like advertising, cultural activities, and student exchange programs build a country's soft power over time. Let's not forget institutions, those big, important organizations that keep things running smoothly. Strong institutions promote stability and help countries build strong, cooperative relationships. They ensure things like government accountability and the rule of law, which boosts a country's standing internationally. Every country has a list of priorities. At the top, you've got the really critical stuff, and at the bottom, the nice-to-haves. This hierarchy guides how countries make decisions. For example, harmonizing tariffs might be nice, but it's not a top priority if two countries are at each other's throats. Cooperation costs can outweigh the benefits depending on the situation. The folks in charge have their own agendas, and these influence whether a country decides to cooperate or go it alone. This is also linked to priority setting. Short political cycles can make it hard to focus on long-term issues like climate change. One government might prioritize military spending while the next focuses on healthcare. Some countries just don't like playing by the rules. While most nations cooperate to some extent, a few prioritize independence above all else. Extreme non-cooperation is rare because it usually leads to pushback from other countries. Now, globalization is all about the interaction and integration of people, companies, and governments across the globe. It's this huge web of connections where goods, info, jobs, and culture spread beyond borders. Let's break it down together. So, globalization is like the world becoming one big community. Over the last few decades, cross-border trade has exploded, impacting both small businesses and entire economies. Globalization isn't just about trading stuff. It's about sharing ideas and working together more easily, thanks to the internet speeding things up. Globalization helps businesses tap into new markets, find new talent, and learn new things. Here are some key aspects. Capital flows means money moving across borders. Currency exchange, swapping one currency for another. Trade of products and services, buying and selling goods and services globally. Cultural and information interaction means sharing culture and information. On the flip side, we have anti-globalization or nationalism, where the focus is on a country's own economic interests. This means limited currency exchange, limited cross-border investment, limited economic and financial cooperation. Why do non-state actors like companies go global? Let's look at three main reasons. First is increasing profits through increasing sales or reducing costs. Companies want new clients and markets to boost sales. This requires investing in new markets, hiring people, and training them. Firms look for cheaper places to operate, cut labor costs, and improve supply chain efficiency. Second is access to resources and markets. Globalization helps companies get to resources like skilled workers or cheap raw materials and find new investment opportunities. Third is intrinsic gain. This is beyond profit. It's about extending horizons, experiencing new places, and learning new ideas. It's personal growth and education, which boosts productivity. Now, globalization isn't all sunshine and rainbows. Here are some downsides. Unequal economic gains. Economic theory says profit maximization helps overall activity, but not everyone benefits equally. For instance, moving a factory overseas creates jobs there, but cuts them at home. Lower standards. Companies in cheaper countries might follow lower environmental, social, and governance standards. This might boost profits, but can be bad overall due to less protection and benefits. Political consequences. Globalization can widen income and wealth gaps and create unequal opportunities. This can affect domestic politics, making it harder for countries to cooperate effectively. Companies might rely on other countries for resources, which can make nations dependent on each other. Supply chain issues can force companies to change suppliers or even stop operations. Okay, now let's talk about the big players in the world of international trade. We're diving into three major organizations that set the rules and keep things running smoothly: the International Monetary Fund, IMF, the World Bank, and the World Trade Organization, WTO. Let's get started. So the IMF is all about keeping the global financial system stable. Their main goals: they make sure exchange rates don't go haywire, help countries pay each other smoothly, and provide financial assistance to countries in a pinch. They're like the financial firefighters of the world, stepping in to prevent and manage economic crises. Member countries pool their resources, and the IMF lends out funds under strict conditions to keep everything balanced. Next up, the World Bank. These guys are all about reducing poverty and boosting sustainable economic growth in developing countries. They fund big projects like highways and schools, offer technical assistance, and provide low or interest-free loans to countries that need a financial leg up. The World Bank is split into two main entities: the IBRD, which lends to middle-income countries, and the IDA, which focuses on the poorest countries. They're like the world's development bank, helping countries build the infrastructure they need to thrive. Last but not least, we've got the WTO. Think of them as the referees of international trade. They regulate trade relationships between countries, serve as the go-to forum for trade negotiations, and work to eliminate trade barriers like quotas and tariffs. Their goal is to expand trade and improve living standards worldwide. They also help settle trade disputes and provide technical support to developing countries. The WTO's roots go back to the GATT, which laid the groundwork for today's global trading system. Okay, folks, now we're going to learn about how countries interact on the global stage, using a framework that breaks them down into 4 archetypes: Autarky, Hegemony, Multilateralism, and Bilateralism. These types are mapped on 2 axes: political cooperation versus non-cooperation, and globalization versus nationalism. Think of it as a spectrum where countries can move around based on their policies and goals. Autarky is all about self-reliance, minimal foreign trade, and financing. State-owned companies run the show. This can make a country politically strong, controlling its tech, media, and industries. China was like this in the 20th century. But there are trade-offs. While it can spur growth, it can also lead to economic stagnation, like we've seen in North Korea and Venezuela. Hegemonic countries are the big players. They lead and control resources on a regional or global level. State-owned enterprises dominate key export markets. This system benefits both the hegemon and the global order, rewarding countries that play by their rules. But it's a double-edged sword. It comes with increased geopolitical risks. Multilateralism is about countries working together in broad, mutually beneficial agreements. Think of Germany and Singapore. They're fully integrated into global supply networks and cooperate extensively with multiple trade partners. This creates a stable and cooperative global environment. Bilateralism focuses on one-on-one cooperation between countries, covering political, economic, financial, or cultural aspects. While countries may have several bilateral partners, these agreements are negotiated individually. Often countries will find themselves somewhere between bilateralism and multilateralism, sometimes leaning towards regional cooperation. This framework helps us understand the costs, benefits, and trade-offs each archetype faces. All right, folks, let's dive into the tools of geopolitics. These tools fall into 3 main categories: national tools, economic tools, and financial tools. Each of these can either promote cooperation or ramp up conflict. First up, we've got national security tools. These influence state actors by affecting resources, people, or borders. They can be active, like actual armed conflict, or threatening, like the mere hint of military action. Some examples include direct actions like warfare, or indirect ones like espionage, or forming military alliances. Take NATO, for instance. It's a cooperative alliance aimed at reducing nuclear threats among the US, Canada, UK, and Europe. But remember, armed conflict is the extreme end. It can wreak havoc on infrastructure, disrupt trade, and create refugee crises. Next, economic tools. These use economic means to foster cooperation or stir up non-cooperation. Cooperative tools include things like multilateral trade agreements, shared markets, and common currencies. On the flip side, non-cooperative tools could be nationalization, where the state takes over private industries. Countries might also impose voluntary export limits or set domestic content criteria for exports. These moves can either help build alliances or create economic barriers. Finally, we have financial tools. These leverage financial means to either build cooperation or drive conflict. Cooperative tools include encouraging foreign investments and allowing cross-border currency exchanges. Non-cooperative tools could restrict foreign investments or limit access to local currency markets. While cooperative financial tools can reduce geopolitical risk by fostering economic stability, they can also expose weaknesses like the dependency on the US dollar. US monetary policy, for instance, can negatively impact countries without dollar reserves. Now, geopolitics isn't just about using one tool at a time. It's a complex interplay of political, economic, and financial systems. For example, cabotage, which is the right of a foreign company to transport goods within a country, requires cooperation on many fronts like security and economic policies. Lastly, let's talk about geopolitical risk and comparative advantage. A country's core priorities and their use of geopolitical tools can shift their relative advantage. Countries that manage to stay low on geopolitical risks attract more labor and capital, while those with higher risks see declines. Persistent conflict threats can drive up asset price volatility, meaning investors will want more risk compensation. All right, let's talk about how geopolitical risk factors into our investment strategies. Geopolitical risk can significantly impact financial markets, and the extent depends on an investor's goals and risk tolerance. Some investors only consider it for long-term impacts on their asset classes or strategies, while others see it as a key factor for generating alpha. We've got three main types of geopolitical risks. Event risks. This focuses on specific dates like elections, new legislation, holidays, and political anniversaries. Political changes can influence investors' expectations of a country's cooperation. Political calendars are often used to calculate event risk. Keep in mind, predictability doesn't lessen the impact but gives investors more prep time. Exogenous risk. This is sudden or unexpected risk that affects a country's cooperative position or the globalization potential of non-state entities. Thematic risk. These are evolving risks like climate change, migration patterns, rising populism, cyber threats, and terrorism. Geopolitical risk can affect investments on macroeconomic, industry, and company levels. Investors look at the likelihood, velocity, and impact of geopolitical risks. Likelihood of occurrence is the probability that the risk will happen. It's tough to measure since many risks are unpredictable. Factors like internal political stability, economic needs, and government motives play a role. Velocity of impact is how quickly the risk affects an investment portfolio. Short-term or high-velocity impacts include market volatility and investor flight to quality, potentially harming whole industries or markets. Medium-term risks affect company processes, cost, and investment opportunities, leading to lower valuations and being sector-specific. Long-term or low-velocity risks might impact asset allocation but have limited immediate portfolio effects. Size and nature of impact. When evaluating risk relevance, assess the impact's size. High-impact risks need more scrutiny than low-impact ones. External factors can amplify a risk impact, especially during economic recessions. The impact could be discrete, affecting one firm or sector, or broad, impacting a whole sector, country, or global economy. Investment teams use scenario analysis to prioritize and make sound investment decisions. Scenarios can be qualitative, quantitative, or both. A simple framework starts with a base case for the risk. then considers upside and downside scenarios and potential market recovery. Quantitative scenarios range from simple to complex, testing portfolio resilience. Effective scenario analysis requires ongoing commitment to creative processes, identifying scenarios, tracking them, and assessing the need for action. Asset managers use strategies to prioritize portfolio risks, minimizing the impact of unexpected changes. Signposts are indicators, market levels, data points, or events signaling a risk's likelihood. Think of them like traffic lights. Green means no action needed, amber means caution, and red means an action plan is necessary. Identifying the right signposts can involve trial and error with a focus on distinguishing signal from noise. Policy changes are typically more critical than political ones. Economic and financial market conditions can signal upcoming trouble, like a pegged currency or declining export value prompting a change in exchange rate policy. Data screens can identify these red flags early for country-level portfolios. Geopolitical risks are unpredictable and can have wide-ranging impacts on investor portfolios, causing market volatility and sudden asset price changes. For instance, during COVID-19, stock prices dropped while bond prices rose due to investors' flight to safety. Risk analysis involves assessing the likelihood, velocity, and impact of a risk to decide on a course of action. Asset allocators might incorporate geopolitical risk into their strategies, favoring countries with a strong multilateral approach. Portfolio managers can include geopolitical risk in their models, considering investment objectives, risk tolerance, and time horizon. Political, economic, and financial cooperation can raise the stakes for global investors, with changes in international cooperation affecting capital markets. That's a wrap on Introduction to Geopolitics. This concludes today's session. Do not forget to practice these questions from the FinQuiz Question Bank and the CFA Institute's end of chapter practice questions. Keep learning and stay curious.